We've had a great start to the year. What do you see in the fourth quarter?
So, we think that markets pretty much deserve to be where they are today, and we're looking for a flat market. We've got a 29.50 target at year end, and we don't feel any, kind of pressure to change that at this point.
So you're not wildly optimistic, but you're not calling for some sort of October crash.
No, well, look, we have said we do think the market is vulnerable to another pullback. Now, we think that looks like something similar to May, similar to August, something 10% or less, not a disaster, but a period of digestion.
And maybe we should welcome that. Tony Crescenzi, you had the Australian Central, we don't talk about the Australian Central Bank much, cutting rates for the third time this year. 16 major global central banks have cut rates, including our own. How much longer can the Feds around the world sort of save us if they have to?
Well, central banks are reaching the zenith of their story. They can't go much further. And overnight, you saw in Japan a big rise in interest rates that's affecting U.S. interest rates. And so it's possible that the central banks have reached a monetary endpoint of some sort, and they need hand over some of the jobs, so to speak, to the fiscal authorities. But the problem is fiscal authorities throughout the world don't have a lot of money to spend. It's not easy for them to borrow. Think of Greece, think of Italy. They've reached Keynesian endpoints. And so the world will need to depend on the capitalists for growth. But the capitalists over and over again throughout time has pulled through. Think of the new products being built in the world. So we'd have to say that the central banks are reaching their limits in terms of their efficacy and the zenith of what they can do.
Yeah, but what's amazing, Tony, normally we have an equity strategist like Lori on and a bond strategist like yourself on. There's you guys are, sort of at friendly war, right? Because it's like you both can't succeed. Not the case. This year, bonds have done great. The TLT, the most widely owned bond ETF, up 17%, almost exactly the same as the Dow or the S&P 500. How much longer can all the asset classes keep going?
Well, the quick answer is until there's a recession. But here's the way to think about it. Global investors are starved for yields and returns. In Europe, interest rates are negative. Same in Japan. Investors think about them as if they're on a desert looking for food. They find it. What is the food? The dips in market prices. The food out there, though, that's poisonous is the one that equals recession. But that's not on the horizon. But it was apropos that you showed that airplane earlier. A view that PIMCO has is that economies worldwide are reaching a speed that's close to stall speed. So it does create risk for 2020, and policy uncertainty need clear up to avoid that stall speed story turning into something worse.
So what does that look like to you? Quickly, again to you, Tony. What is a stall speed if we do stall out? What does that look like?
Well, that's where global investors in the desert, where they devour food and market prices are falling, they wind up eating poison because in a recession, the story changes. Cash flows turn negative for companies. They avoid equities. They avoid credit instruments. But that's not our baseline, but we wouldn't have high confidence in the baseline now given the high level of policy uncertainty.
Lori, it's interesting because it's been a great year for equities. Best 9 months since 1997. We showed our viewers earlier, the best performing sector group in that time has been the bond equivalent of stocks, utilities.
Yeah.
Who'd have thunk it? Well, you guys have been bullish. You've been right on utilities, and you remain bullish on utilities. Why? These are regulated businesses.
So I would say, first off, investors at this point in time, you have to think about who's coming into the equity market. We've been sending a chart all last few months to people looking at the percentage of companies in the S&P that have higher dividend yields than the 10-year Treasury yield. So that's telling me that the thirst for yield is pushing people into U.S. equities. So that supports utilities, number one. Secondly, if you look at valuation, and this is where we do fight with a lot of investors, on the actively managed side, a lot of people don't want to own utilities. They say they're overvalued in addition to not having that long-term growth appeal. But we actually tell people, sure, they do look a little bit overvalued, but they're very, very far away from peak valuations relative to the S&P. So we actually think there's plenty of room left to run.